In this video, we're going to focus on debits and credits. So essentially, out of the five main accounts, which are assets, liabilities, shareholders' equity, revenue, and expenses, each account is denoted either a debit account or a credit account. All this means is that if an asset is a debit account, that means on the debit side it increases, then by default on the credit side it decreases. So asset is a debit account, liability is a credit account, meaning on the credit side it increases, on the debit side it decreases. Shareholders' equity is also a credit account, revenue is also a credit account, and expense is a debit account. And so the thing is, when it comes to debits and credits, for now it's very confusing. So for now, I just want you to kind of memorize it. Asset is debit, liability is credit, equity is credit, revenue is credit, expense is debit. And now we could even assign account numbers to the different assets. So for instance, all assets are either in the tens, hundreds, or thousands. So let's just say, for example, cash. Cash could be 11, 101, or 1001, depending on the company size. So if you're a bigger company like Apple, you'll most likely be in the thousands, whereas a smaller company could be in the 10s, 20s, 30s, 40s, and 50s. Assigning account numbers to different accounts such as cash, accounts receivable, supplies, inventory, etc., just makes it easier to track these accounts within an accounting system. So liabilities are 20s, 200s, 2000s. For instance, accounts payable could be 210. Shareholders' equity, such as common shares, preferred shares, and retained earnings, are in the 30s, 300s, and 3000s. Revenue, such as sales revenue or service revenues, are in the 40s, 400s, or 4000s. Expenses are in the 50s, 500s, or 5000s, such as cost of goods sold or rent expense are going to be in the 500s.